You have chosen to watch this video. But why? Is it because of a recommendation from a friend or family member? Or because of the intriguing and dramatic title of the video? Or maybe, just maybe you know deep down, that something is seriously wrong with the current global financial system. If we had a system with a fixed amount of money as our unit of account, prices would be deflationary. In other words, prices would fall to the marginal cost of production. This is due to the free market forces, where companies are competing for your money. With these market forces and technological development, over time your money would be worth more and more. But why are you not seeing falling prices and increasing purchasing power in your daily life? Until the 1970s, the dollar was more or less backed by gold, which has to some extent limited the government's ability to mindlessly devalue the dollar. Today, the dollar, and every other national currency, is fiat money, which are only backed by the government's power and ability to force citizens to use the currency. Since the 1970s, where the gold standard was officially abolished, the US has devalued their currency tremendously by increasing the supply of dollars. This graph clearly shows an exponential increase in the supply of dollars since the 1970s. If we take a look at the price of gold, measured in dollars, we can see how the price of gold was to some degree flat until the 70s. From the 70s and onward, we see a sharp increase in the price of gold compared to the dollar. In other words, the dollar's purchasing power is decreasing over time compared to gold. So the price of gold tracks the supply of money. The general increase in gold's price compared to the dollar does not mean that gold is getting more valuable over time. It actually indicates that gold is a better store of value compared to the dollar. This is because the supply of gold is lower than the supply of dollars. The yearly supply of gold is about 1 to 2%. The increase in gold's price and value is an illusion. An illusion that arises because we value and compare it to a unit of measurement that is getting devalued over time. But what if this illusion not only affects how we perceive the price and value of gold? What about assets and the stock market? Over the last 10 years, the money supply increased about 100%. It is an average yearly increase of 10%. If we take a look at the S&P 500 over the last 50 years, it shows an average yearly return of 10.5%, measured in US dollars. The price of the S&P 500 is increasing about the same rate as the increase in the supply of money. This graph shows a high correlation between the money supply and the price of the S&P 500. But what does this mean? Well, it means that the price of the S&P 500 and the stock market in general to a large extent is dependent on a new supply of money in order to continuously produce a high return. But what if we take the price of the S&P 500 over the last 52 years and divide it with the supply of money? Then the last 52 years shows a total return of 44%, which is only an average yearly return of 0.8%. Who benefits from this never-ending increase in the supply of money? If the government has to finance expenses like war, social security, healthcare, and so on, it has two ways to finance these expenses: either through a high degree of taxation or by turning the money printer on. The money printer enables the government to indirectly take wealth from its citizens by devaluing the currency and spending the new supply of money. The wealthy elite has a large portion of their wealth stored in stocks and assets. They also benefit from the increased supply of money which causes an increased return on these stocks and assets, as we have already demonstrated. The Consumer Price Index, also referred to as CPI, is a method used by most countries in order to measure price inflation. Most people think that the CPI is a fixed basket of goods and services that is used as a constant unit of measurement in order to get an average number of the general price inflation. But this is a common misunderstanding. What most people don't know is that the methods used in CPI today does not produce a number that reflects the real rate of inflation. Originally, the CPI was determined by comparing the price of a fixed basket of goods and services spanning two different periods. In this case, the CPI was a cost of goods index, also referred to as COGI. However, since the late 1980s, the US Congress embraced the view that the CPI should reflect changes in the cost of living. Consequently, the CPI has evolved into a cost of living index, also referred to as COLI. One of the suspicious methods used in the calculation of the CPI today is that the government can change items in the basket from year to year. The CPI also excludes the price of real estate and housing, which has experienced a lot of inflation since the 1980s. But even if the basket wasn't changed, there is still a major flaw within the methodology of CPI. Each item in the basket is given a certain weight or value, dependent on the consumer's purchasing behavior. An example could be, if consumers tend to buy less meat and instead buys cheap meat alternatives, the cheap meat alternatives would be given a greater weight in the calculation in order to reflect the general consumer's purchasing behavior. As the real inflation goes up, consumers tend to buy lower quality and cheaper alternatives, as seen on this graph. When consumers' purchasing behavior tend toward lower quality and cheaper alternatives, it puts a downward pressure on the CPI number. This does not mean that an increase in real inflation will cause a decrease in the CPI number. These graphs just shows how human behavior changed with increasing inflation, and how this change in purchasing behavior creates a downward pressure on the CPI number, which causes inflation to seem lower than it really is. In other words, the CPI methods used today understates the real inflation. If we measure inflation through today's CPI method and compare it to the CPI method from the 1980s where the basket was fixed, we get two completely different graphs. The CPI method from the 1980s produces a CPI number mostly ranging between 7 and 11% over the last 10 years, which coincidentally reflects the increases in the supply of money. In general, politicians want to use money on projects and activities that they themselves and their wealthy friends will benefit from. In order to direct more money towards those things, the government will to some extent have to limit expenses elsewhere. One of these things is Social Security. This is where the CPI enters the picture, because in most countries the Social Security you can expect to get is affected by the CPI. As inflation goes up, people who receive Social Security require more money to stay afloat. And with high inflation, the government would to a large extent have to increase the Social Security budget. This is where the CPI gets handy. If the government can artificially lower the CPI, they can limit the increase in expenses to Social Security. Another way politicians like to use this fishy CPI method are when they want to brag about the gross domestic product, also referred to as GDP. GDP aims to measure the value or price of the final goods and services produced in the United States, without double counting the intermediate goods and services used up to produce them. Changes in GDP are the most popular indicator of the nation's overall economic health. But in order to know the real GDP, the government has to adjust for inflation. This is where the CPI method becomes handy again. Because an increase in real inflation will naturally increase nominal GDP, and in order to generate a number for real GDP, the government will use the artificially low CPI number. A lower CPI will make the growth in real GDP seem higher. Most employers gives their employees an average wage increase of 3% per year. In other words, for most people their nominal wage is increasing at an annual rate of 3%. If we only look at this variable, it looks great. But what if we compare it to a real inflation rate of, for example, 7%? Then the picture suddenly changes for the worse. As time goes on, you are getting relatively poorer at an exponential rate. In other words, your real wage is falling as time goes on. Do you remember what was explained in the beginning of this video about the forces of the free market and technology? And that prices would be falling when measured from a fixed amount of money as our unit of account. As a society, we are getting more and more productive as technology evolves. This is of course hard to see when we measure our life and the system with a unit of account that's getting devalued over time. But the gain in wealth and prosperity that would flow to us in the form of lower prices then must go somewhere else, right? This gain in wealth and prosperity flows to the top of the pyramid, to the government and the wealthy elite. Your purchasing power is essentially getting redistributed. This phenomenon is known as the Cantillon effect. The Cantillon effect describes how people who are closer to the source of money creation benefits the most. They get to spend the new supply of money before it has moved through the economy and affected prices. Most data and graphs used in this video are from the US. But no matter where you live, your government or central bank are devaluing your local currency. In order to slow down the rate that you are losing your wealth, you are forced to store your wealth in risky stocks and assets. Most rational people would agree that it's insane, that we have to take a lot of risk just to maintain our purchasing power, which is even smaller after the return of investment has been taxed by the government. The practice of devaluating money in order to redistribute purchasing power has throughout history proved itself to be unsustainable. Most empires, kingdoms and nations have for thousands of years tried to devalue money in order to redistribute wealth from the people to the ruling class. And what they all have in common is that these societies and their currencies has collapsed as a consequence of this practice. If only there was a form of money which was uncorruptible, had a limited supply and was unconfiscatable by power-hungry tyrants.